Assalamu alaikum friends, welcome to lecture 2 of AFM. Today we are going to discuss real options. And before I start lecture 2, let me give a recap of what I have discussed in the previous lecture, lecture 1. We went through the cash flow techniques to value and investment. Like we studied net present value, IRR, then MIRR, then discounted payback period, Macalo duration, sensitivity analysis, Monte Carlo simulation, value at risk. These are the things we covered. Okay. You need a little bit help of the previous lecture, especially net present value, for understanding real options better. Okay, so now let us go through this. This is equally very important. Okay, because this real option often comes with a net present value. It is combined. So in this lecture, we are going to focus on principles of option pricing theory. Basically, before you understand real option, you should know how an option works. Okay, what is an option, what are the terminologies that we use in options. Okay, the principles of option will not come, but I have included it in the lecture because it's the basics. First you need to understand option to understand how real option works. Okay, options you must have covered in your financial management, but real option is something which we are going to focus in AFM. Then Black-Scholes option pricing model, you must have heard about it in your financial management studies. This is the model that we use to value an option. Okay, and you need it. Okay, there's a formula for it which you don't have to memorize it because it's given in a formula sheet. Then we are moving towards identifying real options in an investment appraisal. Earlier we told that when we have to invest in a project, we go by net present value. If it's positive, we accept. If it's negative, we do not. But sometimes net present value also has its limitations. That's why we have to know how to value a real option. Okay, in investment appraisal. Valuing real options. First, you need to identify whether an investment appraisal has an option in it or not. Then you need to value it once you have identified. Then we are going to end it with other uses of Black-Scholes model. This is basically a theory part. Okay. Usually they don't tell to calculate, but sometimes you need to calculate. Rarely, I don't think so, but mostly I think it's a discussion part. The other uses. Other uses means other than valuing real options. Now, we are moving towards the first, that is we are starting with options, the terminologies, because it has a specific terminologies in option that you need to understand. Okay, an option, what is an option? If I ask you, option is your right whether you want to exercise something or not. You don't have an obligation, no one is forcing you, it's your right. If you want, you exercise. If you don't want, you do not exercise, right? In terms of finance, okay, an option means you have a right to buy or sell a particular good. You can either buy or either sell. You have the right at an exercise price will be specified to you in advance at some specified date in the future. Okay, now it's up to you. You have a choice there. You exercise, you don't exercise. That's why it's known as an option, right? If you were forced to do something, it's an obligation, then it will not be an option, right? So that is the meaning of option. We have two types of option. One is known as call option, the other one is known as put option. Okay, understand call option very properly. Okay, you don't have to understand put option. The moment you understood call option, put option is just the opposite of it. Understand it like this. Call option means an obligation. Sorry, option means the right to buy. Okay, call buy. If you want to memorize what is call option and put option, sometimes students forget it. And remember, when we are going to study risk management, in currency risk management, there also we have options. That option and this option is different. Okay, this option we are studying is for the purpose of real option, but the terminologies are same. Here also call option is right to buy, there also in the currency also option to buy, but there we are buying currency. We'll not go in detail there. When we go to currency risk management, we'll study it there, but here it is an option to buy a particular good. Okay, buy at an exercise price will be given to you. Put option is the opposite, option to sell. Okay, so call, buy, put is for sell. Okay, get it thorough, get it very, you have to be very accurate in these terms. The moment you get wrong, everything gets wrong. You will choose the wrong options, then you will choose the wrong price, then you will take wrong decisions whether to exercise or not. Okay, so first get familiar yourself with these terminologies before you jump to the real options. If you have forgotten, in case if you remember it, then you can just start with the real options. This is just a revision which is going on. I'm taking you through this before you go to the real option so that you understood this real option, you don't have to struggle so much. Okay, it's very easy. Real option is not at all very difficult. Then exercise price, or another word is strike price. Okay, this is a fixed price, okay, that you can buy a good or a service, that you can buy or sell. This will be given to you. Then the premium. See, for any option, because you have that option, is an advantage for you. It's a flexibility, right? You have to pay a cost for it. Nothing comes free. And it's very expensive. That's why options are quite expensive. So that is known as premium. Okay, that is the cost for an option. Whether you exercise or not, it's not an issue, but you have to pay the cost. The premium you have to pay. It's like for insurance when you have to pay the premium for the insurance. Whether you take the insurance or you do not take the insurance does not matter. Same for the options. Okay. Then we have some more. There are two types of option. One is American option. The other one is known as European option. American option means you can exercise that option at any date until the expiry date. Let's say from Jan to March. 1st of Jan to 31st March. 31st March, the options will expire. So from 1st of Jan to 31st March, in between any date, you can exercise the option. But European option is not like that. European option only on the last date, the day when it's going to get expired, the option, that only you can exercise the option. And again, two types. Okay. One is traded option, the other one is known as over the counter option. Sometimes as a theory, like for discussion, they might ask you these things. Difference between traded option and over the counter option, which one is better? Otherwise, they will not ask you so much of questions on this. Traded option means they are standardized option contracts. That means they are standardized, fixed. The option size is fixed. That could be sold on future exchange. Normally American options. See, futures exchange and all this we are going to cover in risk management. That is section E, right? That is the next section after I finish investment appraisal. So there we are going to study futures and all those things. Okay. That is traded options. Over the counter option means what? It is specifically customized for you. Not everyone will have the same option. It is a tailor-made option. This is usually sold by a bank. This over the counter, usually bank sells it. Okay, and it could be known as European option because over the counter usually they are practiced what at the last date of the option. That's why it is known as European option. Example of European option. Traded option could be exercised any date. Normally American options. Okay. Just knowing the difference between traded and over the counter option is enough. Now we need to know how an option is valued. How do you get that value for option? See, there are two elements that decide the value of an option. Okay. But there is one advantage of option. Before that, understand there's an advantage of an option. One, buyer has a choice whether they want to use it or not. Okay. So if you use the option, you can avoid the downside risk without foregoing the upside exposure. See, if you take the option, your downside risk exposure you are going to avoid. If you do not exercise the option, you can take the benefit of upside exposure. If anything goes up, you can take the advantage. So it's not limiting you from the benefit. There's unlimited benefit that you can have by not exercising the option, by letting it lapse. Okay. Now the value of an option. One is known as intrinsic value. Number two is known as time value. An option is made up of this two values. Intrinsic value will see time value. See, the longer the time is, the more value an option will have. We'll see in detail. Okay. Intrinsic value. Intrinsic value is simply the difference between your exercise price and the price of the underlying asset. That means what is the current price of that asset in the market and what is the exercise price under the option that you have taken. The difference between two is known as intrinsic value. Now go through this table. They will not ask you all these things. What is intrinsic value, the formula for it? You don't have to calculate. But for understanding real option, you need to understand the basics of option first. What is exercise price? What is this price of underlying asset? You need to understand. So as you can see this table, share price is given, exercise price is given. Just find the difference between two. Intrinsic value, if you see. First three are 0 and then 10 and 20. Why first three are 0? Why not it's negative? It cannot be negative. See, if this is a call option, okay? Remember, option to buy. Compare the share price and the exercise price under the first three. Exercise price will remain same, 100, 100, 100, 100, 100. Only the share price will change. If you see share price is changing from 80, 90, 100, 110 and 120. Correct? So what's happening is you need to see when your exercise price is more. Will you exercise the option? Ask this question from yourself if you have to decide on intrinsic value. Will you exercise the option when your exercise price is more? No, because this is an call option, option to buy. Do you want to buy at a higher price or lower price? You want to buy at a lower price in the share price. You don't want to exercise the option and buy at exercise price 100. You rather would prefer to buy at a lower price, which is 80, 90. Okay, we'll come to 0 later. At the 100, where both are 100, we'll come to that position later. First go towards the left, the 2, where share price is 80 and 90. So you will not exercise. When you don't exercise the option, intrinsic value is 0. That means that option does not have any value. See, intrinsic value can never be negative. Because if you exercise the option, you will have some value. If you do not exercise the option, the value will be 0 only. That's the rule, thumb rule. You need to know. Okay. So when you do not exercise, that's why intrinsic value is 0 for the first two. Because share price is less than exercise price. And the position is known as out of the money. Okay. Where both are 100, you still will not exercise. Say you have an option, you can exercise also, you cannot exercise, but the best thing is do not exercise. Why? Because of the premium. See, whether you exercise or not, the high amount of premium you anyway have to pay. So why to waste that premium? Rather do not exercise. So you will not exercise. Hence, according to that logic, intrinsic value is again 0. But that position is known as at the money. See, at the money means both your share price and exercise price are same. That is known as at the money. Then we are moving on to the right side, where share price is more than exercise price. Here you will exercise the option because option price is less, 100 and 100 compared to 110 and 120. That's why it is known as in the money. You will be having money, receiving money is coming in. See, out of the money means money is going out. You can think like that. In the money, money is coming in because intrinsic value is positive. At the money, no money in and out. Okay. So intrinsic value you can easily find out. 110 minus 110, 120 minus 120. Okay. Now, value of the call option increases as the share price increases. Can you see? Just check the first row, the share price, and see what's happening. 80, 90, 100, 110, 120. As the share price increasing, value of the call option is also increasing. When the share price is the highest, 120, the value of the call option is also highest. That is the intrinsic value is 20. So this leads you to a conclusion that higher the share price, higher the value of your call option. Okay. That means your exercise price is low, should be lower than the share price, because rising share price will not mean your value of the call option will be high. Your exercise price also has to be less than the share price. Next, an option can never have a negative intrinsic value. That's what I told. You either exercise the option and have a positive value, you do not exercise and have 0. Only, sorry, on the expiry date, the value of the option is equal to its intrinsic value. See, when your value option reaches the expiry date, at that time, will it have any time value? There is no time left. That is the day it is going to expire. So time value will be 0, no time value. The only value of an option will be that intrinsic value only. That is share price minus exercise price. Okay. Now we are moving to the time value. Second way to value your option, the second element is time value. Okay, time value includes time to expiry. Okay, this also, as the period to the expiry increases, that means you have longer time now. That means you can make more profit before the expiry date, which increases the option value. So this In conclusion, you can say longer the time to expiry, higher will be the value of the call option. Second element, which is again related to the time value, volatility of the share price. Again, volatility means how much your share price keeps changing up and down, up and down, up and down. Does not remain stable. Another word is the standard deviation, you can say. Okay, when you're having a call option and if your share price falls below the exercise price, you are not going to suffer. Why? Because you are not going to exercise the option if share price is below exercise price. So there's a limit to the downside. So what are you losing? Only the premium. That's it. You're not losing entirely. Only the premium you're losing. So it's a limit to the downside. So because of that, if your share price is very volatile, keeps going up and down, up and down, up and down, will not affect you so much because your downside is limited. Only the maximum you can lose is premium. That's it. So that's why higher the volatility, that, or you can say standard deviation, again, this will increase the option value. Why it is under the time value? Because volatility of the share price has to do with the time value. According to the time only, it will keep changing. You need a time for the volatility of the share price to take place. Third is, okay, before third, however, the option holder gains if the share price increases. Yes, if share price increases, the option holder gains. Why? Because you exercise the option. If share price goes up, you exercise the option. And there is no limit to the upside. Upside, there's no limit. Maximum positive gain you can gain, but if you have to risk is limited. Only this much you can risk. So isn't it good? Upside, there's no limit. That maximum this much only you can gain. Whatever gain it is there, you can gain it. If the share price keeps if it increases, because you are going to exercise the option. Thus, the greater the volatility, the better it is. Okay. Third is the risk-free interest rate. The interest rate, because when the time is long, interest rate can keep changing. Okay, that's why all these three elements are linked to the time value. See, exercise price has to be paid in the future. Are you paying it now? No. So higher the interest rate, the lower the present value of exercise price. If your interest rates are higher, your present value will be low of the exercise price, because that is something you're going to pay in the future. You have to find the present value of that exercise price. Now it will be lower if interest rates are higher. So what does it mean? It reduces the cost of exercising and adds value to the current. That means your call option value will go up. If interest rates are higher, call option value will go up. How? Because it reduces your exercise price. If your exercise price is reduced, it's good for you, right? You're going to exercise the option because you want the exercise price to be low. So if high interest rates reduces the exercise price, lower the present value of exercise price, means you will exercise the option. That means current value option will increase. Call option value will increase. Okay. Now, let us summarize everything what we have discussed. First, we'll go through call option. That's why it's in red. Then we'll go through put option. You understand call option, you will automatically understand put option. Okay. So these are the 5 variables. Remember this. These are the 5 variables that affects the value of the call option. Your call option value is determined by these 5 variables. Number 1, share price. Number 2, exercise price. Number 3, time to expiry. Number 4, volatility. Number 5, interest rate. Remember this. This you cannot forget. You remember this table? Whatever I have just explained to you before this was just an explanation. Now you will understand why something is increasing, something is decreasing. That's why we went through all this. If I suddenly show you this table first and tell you to memorize this table, will you think it will give you any help? Maybe in the short term, yes, but long term, no. Because you will not know if share price increases, why call option increases. For call and for put it decreases. Now you will have a better understanding because you went through the logic. So for call option, if share price increases, value of the call option increases because your exercise price is less. You will exercise the option. But for put, you see it is the opposite of call when share price increases. Because option to sell, put is an option to sell. If share price increases, you definitely want to sell in the open market, right? You do not want to exercise the option and sell at a lower price, at your exercise price. So that's why for value of the put will decrease when share price increases. Okay, coming to the exercise price. Exercise price increase means you will not exercise the option if it's a call because you do not want to buy at a high price. If for put is the other way around, you will exercise the option if the exercise price increases because you want to sell at a higher price now. You're understanding the logic now. So value of the call option decrease, value of the put option increase. It's the opposite. If you see share price and exercise price for call and put is the opposite. One increase, the other one decrease. Exercise price decrease, value of put increase. Remember it like this. They have opposite relation. But first understand the logic. This will automatically help you. You don't even have to memorize this table. You understand the logic. If share price increases, what will happen to the value of the call option? Whether it will increase or decrease. You understand this much. Automatically, you will be able to write. But this is just a summary, like in front of you. Then we are coming to the third variable, time to expiry. This is for both. It is same. Longer the time to exercise the option, the value of the call and the put will increase. Volatility also is the same for both call and put. It will increase. But interest rate, for value of the call, it will increase. If interest rate increases, value of the call will increase because you will exercise the option now. Exercise price will be lower if your interest rate increases because present value will be low. For value for put is the opposite because it's an option to sell. If interest rate increases, value of the option will decrease. Okay, that's why I told you understand call, apply to the put, you will understand and see whether you understood it or not. Rather than just memorizing will not help you. Okay, but this is the main thing. Okay, from here we are moving on towards a question. A pension fund manager is concerned that the value of the stock market will fall. If he's concerned that the value of the stock market will fall, which option should he take? Call or what? Call or put? It's a put option, buy put option. See, call option is when you are worried when share price will increase or stock market will increase because you want to buy at a lower price. But stock market will fall means you are scared because you cannot make a profit. If you have to, so you need an option to sell. When you want to sell, okay, that time only you will be concerned if the stock market will fall. So if stock market will fall, you will get a put option. Option to sell. Okay, so remember it. Whenever you are concerned about the value of the stock market will rise, it will be a call option. When it will fall, it will be a put option. Because you do not want to buy at a higher price. If stock market keeps increasing, you do not want to pay that high price. That's why it's a call option. You want to buy at a low price. Opposite for put option. When the market falls, you do not want it to fall so down so that you have to sell at a low price. You want to sell at a higher price. So put option to protect. Now we are moving towards the model. Black-Scholes option pricing model. We have studied call. Okay. We know the properties of put also opposite of it. Now, not everywhere call and put are opposite. Okay, remember. For two variables, one is risk-free interest rate, the other one is time to expiry. This two, under both it increases. Okay, call and put. Other three variables is different. So using the Black-Scholes to value call option, you need to know this formula. This formula will be given to you in exam formula sheet. Okay, in your CB platform, you can just open it. But you need to know in each one which variable you need to put, what number you need to put. There will be so many numbers given to you. That's why we need to go through this formula first. Okay, so value for call option is equals to PA times, okay, it is multiplication. Multiplication sign is not given there, but you need to multiply. PN multiply by ND1 minus PE multiply by ND2 into E to the power minus RT. Looks a little bit confusing. What is it? No worries. We have a solution for it also. We are going to do a question and I'm going to use this formula and show you. Where D1 is equals to and D. You need to understand what D1 and D2 is. You need to calculate it first. So D1 is equals to IN, that is logarithm. Okay. ln is a logarithm of PA divided by PE plus R plus 0.5. 0.5 is fixed. It's in the formula. Into S squared times T. Divide by S to the square root of T. Okay. And D2 is, first you need to find D1. If you cannot find d1, you cannot find d2 also, because see the formula, d2 is d1 minus s to the power s square root of t. So if you do not get d1, d2 also you cannot calculate. D2 is dependent on d1. Okay, and you need to calculate d1 and d2 to 2 decimal places. I will tell you why 2 decimal places, but it has to be 2 decimal places only, and there's a reason why. Because we are going to use a normal distribution table. In normal distribution table, everything is to 2 decimal places only. Now we'll understand what each variable stands for. Even if you don't understand this much also, don't worry, we have question coming up. PA is your share price. This will be given to you. That is the current price of your underlying asset. PE is your exercise price. This also will be given to you in the exam. R is the risk-free rate of interest, will be given to you. Time is the time until expiry of option, and usually they give it in years, 5 years, 6 years, 2 years, not that long also, but 1 year, 2 year, like that. You have to take it in decimal. Okay, I will show you, don't worry. S is the volatility of the share price, or another term is standard deviation. Then ND, you need to use normal distribution table. I will show you what this normal distribution table is, how it looks like, how to use the table also. I will show you. I'll be showing. E is the exponential constant, 2.71828, 828. In the calculator, E is there, so you can use it. You can just directly use E. Or if you want to use the value, you can use 2.71828. But better to use E, okay? Then logarithm, okay? The natural logarithm, the logarithm base is E. Then we have PE into E to the power minus RT. Present value of the exercise price, calculated by using continuous discounting factor. If you're not understanding this, leave it aside. Through question I will show you, you will understand better. Now, let's come to the normal distribution table. This is how a normal distribution table will look like. It will be given to you in the exam. You don't have to worry about it. I will teach you how to read this table. It's very important. You should know whether you have to read it first vertically, then horizontal, or horizontal and vertical. That is very important. As you can see, first one it is 0.00, the 4 decimal places. Okay. Now, you saw the previous distribution table. This table you need to calculate your ND1 and ND2. Okay. That's why you need that table. If your D1 is greater than 0, first you will calculate D1. Then only you will find ND1. N is the probability you have to multiply with the D1. If your D1 is greater than 0, that means positive figure. Add 0.5 to that number, whatever number you get from the distribution table. If it is less than 5, less than 0, or it means a negative number, deduct that number from 0.5. That means 0.5 minus that number. Okay, if you are not understanding this also at this stage, don't worry. We have a question for all this, which will solve your doubt. But this is this thing. For example, D1 let's say is 1.05. I told you D1, D2 always 2 decimal places. There's a reason, because normal distribution table is 2 decimal places. 1.05. So your ND1 will be, from the table, it is 0.3531 plus 0.5. You have to add 0.5. Why? Because D1 is 1.05. It's more than 0. It's a positive figure. That's why you have to add 0.5, which is 0.8351. Now, just go through this table. I know it's very small, maybe. I've just taken the snapshot of that bigger table, and I've used 3 different colors to tell you how to start. Okay, first start with 1.0, highlighted in yellow color. You always have to start with this vertical axis. This is known as y-axis. When you are reading numbers, start with y-axis always. That means in column you need to go downwards. Okay, 0, 0.0, 0, 0.1, 0, 0.2, 0, 0.3. The 1 decimal places you can see, right? Start reading from there. What is the D1 number? 1.05. So first 1.05 will not be given to you just like that. But at least you need to find out 1.0 is given to you or not. At least to 1 decimal place. First you need to find 1 decimal place, that is 1.0. That's why I have highlighted it in yellow. Okay, I think you can see it. 1.0. After 1.0, what do you want? You want 1.05. That means 0.05, two decimal places. So 0.05 go to the 1, go up the fifth column. Oh, sorry, I should say the sixth column, which I've highlighted it in green. So first is yellow, then is the green. Then you need to see the green across 0.00, 0.01, 0.02, 0.03, 0.04, 0.05. That's the two decimal places. You see, this is why you need to round up your D1 to two decimal places. If you take it 1.053, where will you get 0.053 in that table? You will not get. Everything is to two decimal places only. Max is two decimal places. So that's why you need to round it up to two decimal places. Even if you're getting D1 more than two decimal places, round up to two decimal places. Because this table only you can use two decimal places. Okay, so 0.00, 0.01, 0.02, 0.03, 0.04, 0.05 highlighted in green. Now add 1.0 with 0.05. It should give you 1.05. This is the reason. This is how you need to use a table. Check for the other number. Check a different number and see. Are you able to use this table or not? The most important thing is first you should be able to use the normal distribution table to use Black-Scholes option pricing model. If you are not able to use this table comfortably, you cannot do this question. You cannot proceed only because the starting point is D1 to find the value of the call option. Then the final answer that you get is in orange color, which is 0.3531. That is the probability. That is the number that you need to take and add with 0.5. Not 1.05 with 0.5 or 0.05 or 1. No. That four decimal places, 4-digit number. The 4 decimal places number only you need to add with 0.5. It will always be 4 decimal places. The final answer. That is, you can see 0.3531. Highlighted it orange color. If it was negative, how can you use this table? Again, you might ask me this question. If this was minus 1.05, still the same number. It will be 0.3531 only. Same way you have to start with. The older thing is you will deduct this number from 0.5. 0.5 minus 0.3531. That is the difference. That's it. You change the sign. Not 0.3531 minus 0.5. No, 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 no. Your ND1 and ND2 should always be positive, which is 0.8531. That cannot be negative. Okay. So that's the thing. But with the question, I will show you this thing. Both the positive and the negative, I will show both the sides how to take. So don't worry about it. So later, if you want to come back and revisit this again after doing my questions, then you will understand things even better. I'm just explaining you the concept first so that when we do the question, we are just applying the concept. That's it. Now, whatever the method formula I have shown, it is only to value the call option. But we have, in reality, we have put options also, option to sell. We can still use the same model to value put option also, luckily. Imagine if it was not there. Okay. There is a formula in your formula sheet you will see known as call parity formula. Call parity. Through this you can find out. But the problem is not a problem, but you have to do more work if it's a put option. You have to calculate call option, whether it's a call option or whether it's a put option. You first have to calculate the value of the call option. Because without finding the value of the call option, you cannot find the value of the put option. That is an issue. Because the word is call parity formula. Through call only you will find the put option. Indirectly you have to find. Directly you cannot find the value of the put option using Black-Scholes option pricing model. You understanding? Call option first, then put option. Okay, this is the formula. It's there in your formula sheet. Where C minus PA plus P into E minus RT. C is the value of that small c that you can see is the value of your call option. Already you must have found it out. Minus PA, that is the price of the underlying asset, plus exercise price into e to the power minus RT. E to the power minus RT means present value of exercise price only you are finding out, right? You are discounting it. That is e to the power minus RT, not e minus RT. E to the power minus RT. Okay. There are two steps. Okay. Again, I will repeat the steps to find put option. Step 1. First find the call option normally using Black-Scholes option pricing model. Then using that find the put option using this formula that is known as put call parity. Okay, now since you have an understanding of everything call and put option, Black-Scholes option pricing model, now we are going to do a question where we are going to find the value of both call and put in one simple question only, before I go and touch the real options. So through this one question, I'll be showing you how to find the value of the call option as well as the put option. Okay, you can do multiple questions, you can do more questions on it. Okay, so and remember, all the 5 variables that affects the value of your call or put option will be given to you. You just have to put it in the formula and work it out. Okay, so the current share price is $100, exercise price is $95, risk free is 10%. But remember, when you're taking risk free, you should always take it in terms of decimal. That's why they have already rounded up for you. But in the exam, they will only give you 10%. You have to do this working. You should always take decimal, no percentages. Even the years you have to take it in terms of decimal, percentages in decimal. Okay, exercise price and share price as it is you can take 195. Okay, standard deviation is 50%, but you cannot take 50%, you have to take 0.5. And the time to expire is 3 months. Sometimes they might give you years, sometimes they might give you months. Usually they give in months. So 3 months means you have to convert it in decimal. How do you take it? 3 over 12, which is 0.25, or 1 over 4. 1 over 4 means 0.25. Okay, now you calculate the value of the above call option. Before I calculate, let me tell you that in the CBE, because you are going to give your exam on a CBE platform, you should be familiar with 3 formulas. Okay, in your Excel. One is known as ln, that is logarithm, exp, exponential, and normal distribution, norm test, that is it stands for normal distribution. This spreadsheet functions are already there to calculate the option value. When I do a question on CB platform from a revision kit questions, I will definitely show you how to use this formula there. Okay, now it's a bit too early for me to start that. Now I will manually show you how to find the value of the call option. So what should be my starting point, guys? Whenever a formula is there for specific thing, starting point is formula. Now the question is, should we write the formula because it's a CB platform? My answer is no. Don't waste time. You just have to put it in the formula. That's it. Use the numbers in the formula. You don't have to write the formula. It's already there in the formula sheet. You don't waste time writing it again. But for your understanding how I'm going to, this is the first time I'm going to do a question and I'm going to show you how to use it in the formula. That's why I'm writing down the formula for you guys. Okay. So the formula, first you need to starting point is you need to calculate D1. Second is you need to find out D2. Third is you need to find out ND1. I'm showing you the steps before I write the formula. This is always the step. Always you have to follow this. Please mark it somewhere. ND2. Then only the main formula. Apply it and find the value. 5 steps. Okay, so let's start with the D1 formula. I will write it for you. Okay, it's already there. Okay, D1 formula, all these formulas are there in the exam. It is the logarithm of PA over PE, that is price of underlying or share price divided by exercise price, plus R. R is risk-free rate, plus 0.5. This 0.5 is always fixed. S squared. S is your standard deviation squared. See, sometimes for standard deviation, they might give you variance also. If variance is given, take the square root of variance. We know square root of variance is standard deviation. Okay, I will write it here for you. If variance is given, sometimes in terms of standard deviation, they give variance. So square root of variance, you have to find out. You cannot take variance. You have to take the square root of variance because you need standard deviation only in the formula. Okay. 0.5. This is S. Okay. 0.5 into standard deviation squared. 0.5, yeah, standard deviation squared, multiply by time. T stands for time. divide the whole thing by s square root of t. S is standard deviation multiplied by square root of time. Now we are going to put the number in the D1. Okay, first step you can eliminate in your CBA platform, but D in Excel you have to put it in the cell. Maybe you can put 100 somewhere. You can write it down, right? PA is equals to 100, PE is equals to 95. In different cell you can write. So when you're putting the number in one cell, you can just work out the calculation, right? 100 divided by 95, take the logarithm of that. Or in different cells you can take this working. But when we go to Excel, I will show you how to do it. But you can try it on your own. After doing this manual thing here, go to Excel, open your online this thing and try to do it there and see whether you can do it or not. So logarithm of what is the share price? 100. Exercise price is 95 plus R. What is R? R is 0.5, 10%, right? Plus 0.5 standard deviation was multiplied by standard deviation was 50%, that means 0.5 squared. This 0.5 is the standard deviation. This 0.5 is fixed. Okay, this is this 0.5. Don't get confused with this 0.5 and this 0. But the other 0.5, coincidentally, standard deviation is also 0.5 in this case. Not always. Times T. T is 3 months. That means 0.25. Okay, outside the bracket means multiply the inside the whole thing. First perform the calculation inside. The whole thing multiply by 0.5. Sorry, 0.25. The whole thing. I'm putting a big line, okay? This will be a little complicated when you try to do it in the calculator. If you're not good or smart enough in calculators, you might have to do it in steps, break it in steps and do it. If you cannot do it in one go. Or you can do it in Excel also. 0.5 is the standard deviation, square root of time. Time is 0.25. Now, after doing everything, okay, I will show separately. Since this is the first time in your answer, if you see, they didn't show separately. They just showed the final answer D1. But I'm going to do it in parts, okay? Maybe I'm going to use a different color now. First, I'm going to get this answer. The logarithm of 100 divided by 95. Let's do that. In your calculator, you are already given the logarithm function, the ln, okay? And automatically the bracket will start for you if you are using the manual calculator. The scientific calculator, make sure you use it, not the normal calc. There, 100 divided by 95, close the bracket. Okay. Or you can do first 100 divided by 95 and then just take the logarithm of the answer. That way also you can do. But in whatever way you do, make sure the answer is same. Okay. So try both the ways. Logarithm 100 divided by 95 at one stage, or 100 divided by 95 first and then take the logarithm of the answer. In any way, both the ways I have tried, I have got this answer. 0.05129. Let's take it to this much. The number is bigger, but it's okay. Plus. Now I'm going to use a different color, maybe blue color, to get this part. This whole thing. Okay. How are you going to do? You have 0.1 plus 0.5 into 0.5 square. First, do the multiplication, bottommost. 0.5 squared multiplied by 0.5 plus 0.1 into 0.25. You should get 0.05625. Make sure you get this answer. Until you don't get it, stop and do it. What did I do? See, I will show you again. 0.1 plus 0.5 multiplied by 0.5 squared I did first, 0.25. Leave this 0.25 outside for time being. Okay. Then 0.1. Okay, I'm going down here. 0.1 plus 0.5 into 0.25. it is 0.125, the whole thing 0.25 still. First add, because inside bracket I have to solve first, because if you see the formula itself they have shown a bracket here. There's a reason why that bracket is there. Don't first multiply with t and then add with 0.1. No, inside bracket solve first. So it will be 0.225 multiplied by 0.25, which will give you, that means inside bracket is 0.0225 and time is 0.25, which will give you 0.05625, exactly the number which I got here. You see? Now, which color should I use? Green color? Okay, now green color. 0.5 multiplied by square root of 0.25. Make sure you know how to find the square root also. The signs are there, which is 0.5. So this will be 0.25 only when you multiply. Okay. So 0.05129 plus 0.05625 divided by 0.25. Now I think you can do. First the addition, then the division. Add both the numerators and divide by 0.25. I'm turning back to my red color. So D1 will be equal to what? If you do the top part, okay, you will get, wait, this one will give you 0.10754 divided by 0.25, which will give you 0.43016. Okay, number may be a little different because since I rounded up the figure here, I didn't take the whole figure, but it's okay, it does not matter. Can you take this whole number? My question is this: stop. Don't be in a hurry to finish a calculation. Understand? Stop at each stage and see, ask yourself, is it correct? Did I forget anything? I told you D1 can be only taken to 2 decimal places. This is 5 decimal places. So round up 0.43. This is your answer. That's it. D1 0.43. Only this much you can take, 2 decimal places. Now we are moving to D2. D2 is little simpler. First I will write the formula for D2. It is D1 minus, sorry, I will write again. D1 minus standard deviation times square root of t. Okay, that means what is D? Sorry, I'll write downwards. I think downward is easier. What is D1? Which number should you take when you write D1? The whole number or the 2 decimal places? 2 decimal places. Use this 0.43 only. 0.43 minus S is what? 0.5 times 0.25. Okay. So 0.43 minus, first solve this part. It will be 0.25 only. Because square root of 0.25 is 0.5. 0.5 multiplied by square root of 0.25. So this square root of 0.25 is 0.5. So 0.5 is into 0.5. Outside you have 0.5, inside you have 0.5. That's why it is 0.25. Now 0.43 minus 0.25. So what? 0.18. So it's already in 2 decimal places. See, when you take D1 as 2 decimal places for the calculation of D2, automatically your D2 will come in 2 decimal places. Even if it does not come, make sure you round up, because this is, in this case, this number is 2 decimal places. That's why the 0.25. So this is 0.18. D1 also you got, D2 also you got. My question is, this was all these things, D1 and D2 was step 1. Now comes step 2. I'm taking a little longer for this because this is your first question. You get this straight, rest everything you can do it on your own. That's what I wanted to. I wanted to set that base for you from the very beginning, rather than trying to finish, normal distribution table. Now you have to use normal distribution table to find n d1 and n d2. So this for this n only you want normal distribution table. D1 already you found, D2 already you found. D1 and D2. You just need to multiply n into D1, n into D2. For this n only we are using normal distribution table. That probability only we want to find out. Okay, my question is, always ask this question, should I add 0.5 or should I deduct the number from 0.5? Sometimes you have to add one. For D1 maybe you have to add, D2 you have to deduct. Sometimes both you add, sometimes both you deduct. Sometimes D1 you deduct, D2 you add. In this case, tell me, look at your D1 and D2. They're positive figure, greater than 0, greater than 0. Both are positive figures, 0.43 and 0.18. Not always it's a positive figure. You might get negative figure for D1, D2. Only your n D1 and n D2 cannot be negative, but D1, D2 can be negative or positive. This both are greater than 0. So in this case, your problem is solved. Add 0.5. That's it. So n, write it, n d1, n d2. When you're writing n, don't write d1, d2 again. You have to write n when you're using normal distribution table to make it clear that you are using normal distribution table. 0.5, 0.5, plus, plus. After that, you have to use table. Both 0.5 you have to add. Now, normal distribution table also I have. Okay, for D1, it is 0.43, 0.18. This is the table we are going to use. Okay, I will write here in case you forgot. First, we'll start with D1. 0.43. See, first you start with first decimal place, 0.4. To use the first decimal place, 0.4, you have to go like this. This is 0.4. After that, you have to add 0.03, 2 decimal place to it, with 0.4 plus 0.03 to get this 0.43. So that 0.03 is here, across. Look for the second digit. Second decimal place is 3 here. First decimal place is 4 here. That's how you decide. 0.43. And the intersection of this is the number. This is the amount that you want, which is 0.1664. Put here. That is the number you wanted. 0. Always round up 1664. How will you know whether you are correct or not? This should be 4 decimal places. Always. What you are adding or deducting from 0.5 should be 4 decimal places. That will tell you whether you are right or wrong. So this will be equal to 0.664. Sorry, 664. Next, D2. D2 also similar way we'll find out. We'll see. D2 is 0.18. So first find 0.1. It is this. Then 0.08. It is this one. Then you go and search. It is this. 0.0714. Just put it. Go down and put it there. You only need the table for that much. That's it. After that, you don't need the table. So it will be 0.5714. Now, step 3. This number, keep it. You need it. Step 3. Black-Scholes model. Put this number. Put it in formula. Whatever you got, D1, D2, ND1, ND2, now you put it in the formula, main formula. What is the main formula? See, C equals to, that means value for call option equals to PA underlying asset multiplied by N D1 minus PE N D2 E minus RT. So PA is the underlying asset 100 multiply by ND1. ND1 we just found out, this one 0.6664. You get it? Minus, or maybe you can put a bracket, PE, that is your exercise price, which is 95. Multiply by ND2. There are three separate sections here. PE, ND2 and E minus RT. Understand? ND2 is 0.5714. This one. And multiply by, there are three sections, 95, 0.5714 and E. E as it is, you can use it. So there in the calculator. Minus, it should be minus always. E to the power minus. RT, R is risk interest rate. Rate of interest rate is 10%, 0.1 into T. T is time, 0.25. Make sure this 0.1 into 0.25, it comes as a power, minus as a power, okay? Separately I will show you, rather than doing it in one go, so that people who wants to know the breakdown understands. It will give you 66.64, the 100 into triple, then this part, the whole part I'm telling, will give you this you can multiply in any order, because all three are multiplication. If you are not able to get the E in your calculator, press shift and the logarithm sign. You will get E. Automatically to the power is there. So you just have to put minus 0.1 into 0.25 and close the bracket. You just need to put a minus sign, minus 0.1 only once, minus 0.1 into 0.25. Automatically the bracket will start, automatically it will be given as a power. Start multiplying that figure with 0.571495. See, when I have to do what I do, I go backwards, because I feel that is the smartest technique. First I find this, using that number I multiply this and this. You can do it in any order, it's up to you. 52.94. It will give you 13.7. 697, 13.7. Or you might get 13.8 also. See, one or two decimal places here and there will not affect your answer so much, okay? Does not mean you're right or wrong. You will get the marks. You will get the full marks. Some of you might get 13.6. Some of you might get 13.8 or 13.7. In this three range, if your answer is correct. So do not break your head for that exact number if you see your answer. So answer is 13.7. This is the value of the call option. 13.7 dollar, always in dollar sign. See, this you can split between two. What did we study early? Intrinsic value and time value gives the value of the option. So intrinsic value is, you can find out how. 100 minus 95, intrinsic value means what? Underlying minus exercise price, which is $5. So out of this 13.7, $5 intrinsic, time value is what? $8.7. The balance. Right? Now, call is over, 13.7. What about put option? Now we'll find the value of the put option. Put option is call option minus price of underlying asset plus exercise price multiplied by e to the power minus RT. Okay, so already 13.7 you got, minus 100 is the underlying asset, plus. Okay, just find the e to the power minus rt means you're finding the present value of exercise price only. Exercise price is 95. 95 into e to the power minus rt. Shift e. It will be 0.975 something multiplied with 95. It will be 92.65. This part will give you 13.7 minus 100 plus 92.65. See, it will automatically be less than 95 when you find the present value of it. Okay, that's how you know whether you're right or wrong. It cannot be more than 95 when you're finding the present value of 95, because this is the discounting factor, compound discounting factor that you're multiplying. So this has to be less than 95 always. In any case you're taking, should be less than your exercise price. So 13.7 minus 100 plus 92.65. Again, the value of the put will be in dollar. How much it will be? This as it is you can take in one go. You don't have to apply bottoms when it's plus and minus or multiplication and division. It only comes when plus minus multiplication division different sign comes. Plus minus or one go you can go. 13.7 minus 100 plus 92.65 will give you $6.35. This is the value of the put option. 13.7 is the call, 6.35 is the value of the put option. Or if you want to first try this the other way around, add both and then minus that answer from 13.7, we'll see how the answer differs. The answer differs a lot. You have to go in this order. 13.7 minus 100 plus 92.65. Okay, this has to come first. Not 100 plus 92.65 and then deduct the answer from 13.7. The number will be very big. If you do it like that, we'll see what the answer will be. Because it's a good thing from learning from mistakes also. It's better you do the mistakes with me and learn rather than you later on making the mistakes. It will give you the amount as, if you try to do the other way around, minus 178.95. This automatically should give you a sign that it's wrong. First of all, it cannot be negative. Second, it cannot be big, very big. Look at the value of the call option, 13.7. Your value of the put option will be less than the call option. It cannot be so big. You will see the range. Number cannot be very high or very less. You see, this is totally an outlier, an extreme number, and also a negative sign, which cannot be. It has to be a positive. Okay, so now you see that the order of your calculation matters a lot. That matters a lot. The way you put it in the calculator, the numbers you get matters a lot, and the way you use the normal distribution table. So these are some few tips that I've given you. Now we'll be moving on towards the assumptions of the Black-Scholes option pricing model. This also has its assumptions even though we use it to value the model. We are done with this question. And I advise you, please look at your past paper. Now you are in a position, go to a past paper and don't wait for me revision kit questions. Pick up any question which has this Black-Scholes option pricing model and do a question. Assumptions of the Black-Scholes option pricing model. This you should know because this they can ask as a discussion question in AFM. The options are European calls. See, one assumption that Black-Scholes assumes is that options are practiced, like options are exercised at the end of the expiry date. Like European call means exercising at the end of this. But in reality, you might sometimes exercise the option way earlier, right? So that's just an assumption. Second assumption is there are no transaction costs or taxes. That means basically the model is a simplified version of reality, but in reality we do have transaction costs, we do have taxes which are not taken into the account. For example, when you're taking share prices, it has transaction cost and all, right? And also the taxes. When we are taking the interest rate, okay, interest are tax deductible, the rate of interest, but we do not take We did not take the taxes in the picture because we assume there are no taxes and no transaction costs to make the model more simplified. Third, investor can borrow at the risk-free rate. That's an assumption. That's why we take the risk-free rate that they just give. Fourth assumption is the risk-free rate of interest and the share's volatility is constant over the life of the option. That means your interest rate and the standard deviation that they give. But in reality, it's very hard to predict. In your model, they give you standard deviation, they give you the rate of interest, and you are supposed to calculate the value of the option. But is it constant? No. Then we have share price. See, the share price are observed by looking at the past, right? But is it very accurate to do that? How can you predict the future share price volatility with the past? It's not a very accurate. Okay. Then the share price. The share price follows a random walk, and the possible share prices are based on normal distribution. We assume that share prices are based on normal distribution. They're distributed normally, but in reality, they are not so. They can follow random walk. Randomly, they might increase or decrease. But for the sake of this model, to make it very simple, to give a value to the option, we do that. Because if we don't say that they are based on normal distribution, we cannot remember the normal distribution table that we use to calculate ND1 and ND2. That's the reason. No dividends are payable before the option expiry date because it's shares. Okay, on shares we pay dividends. But for this, we assume that before the option expiry date, because see, these options are treated as European calls. That means you will exercise at the end of the year, expiry date, right? So that time dividends are not payable. Whereas if it's payable, it's an expense, you have to deduct it from the share, your share price. But it is not, because it will affect your share price, right? Paying out dividend will affect your share price. But we are not taking that into account because we assume no dividends are paid. So these are some assumptions, which if asked for as a discussion question, you need to be able to discuss these points. Out of these points, they will not ask any other points. Usually 5 to 6 points, they might ask. So now we are heading towards next term known as the delta and delta hedges. Okay, this part comes in a very small for a very small number of marks, like 3 marks, 4 marks. More than that, if you have seen the past paper, it does not come, and it does not come very frequently. It comes rarely, some 1 or 2 times, and if it comes, the amount of marks is less for it. But we should not neglect, even if it's a 1 mark question, we should still attempt to do it. That's the reason it's here. It's there in your syllabus, it has been tested in the question. That's the reason we are studying here. Okay, so delta and delta hedges. What is delta? First, you should know that the figure that ND1 you have calculated, that is known as delta. In short, delta measures the change in the option value, which would result from the $1 change in the value of the underlying asset. That means if your underlying asset changes by $1, what is the change in the option value? That change is known as delta. Okay. Then an investor can eliminate the risk of his. Okay, see, we are talking about hedges. Hedges means we are trying to eliminate or reduce the risk by taking certain actions. That is the meaning of hedges. You will definitely know this more when we are studying risk management. Okay, but here we only want to know delta hedge. That's it. That is known as delta hedge. This hedge is known as delta hedging. Means you are eliminating risk or you are reducing, minimizing risk. But this is regarding the delta. Okay, how you can eliminate the risk in the changes in the option value. That's why this term is known as delta hedge. So now you know the terms. Now I'm going to explain you the process how delta hedge works. Okay, I'm going to go a bit slow because it's easy to get confused. Okay, an investor who holds a number of shares and sells an option writer. See, the one whom you are selling the share is known as an option writer. You are an option holder. The one who has the share are the option holder. The one whom you are selling is known as an option writer. Okay. So an investor who holds number of shares and sells a number of call options. When you're selling a call option, you're selling to the option writer. Okay. In the proportion dictated by the delta, you are doing this buying and selling in the equal proportion. That proportion is known as ratio hedge. Okay, dictated by the delta ensures a hedged portfolio. If you do by that hedge ratio, You are ensuring that your portfolio is hedged. Okay, so in a hedged portfolio, what are you doing? You'll be having gain if you are holding number of share, and you'll be losing out if you are selling this call option. You understanding? In your share market and in an option market, okay, if you are gaining somewhere, if you are gaining in the shares by holding shares, you are losing in the option market. If you are losing in the share, you are gaining in the option market. So the relationship is always opposite. You cannot gain in both the places or lose in both the places. The idea is one place will be gaining, the other place will be losing. That's how the gain and the loss cancel out each other, and you are hedged. We'll explain this with numbers, with figure. Okay, but this is the way you need to calculate. Okay, this is just a method of it. So number of option calls to sell is equal to number of shares held divided by ND1. Okay, see, for it to be 1, okay, like hedged perfectly, your number of share that you are going to sell, okay, sorry, not number of share, number of option calls to sell should be equal to your number of shares held. Okay, but in reality it's not so. It's not always 1% change in share price will lead to 1% change in option in the options also. No, it's not like that. That's why we have this change known as delta, how much the change is, and it is measured by ND1. Okay, so we divide that ND1 by the number of the shares held. Number of shares held divide by ND1. You will get the number of option cost to sell. How many option calls you have to sell to hedge? Okay, like that, similar way, you, if you have already written call options, okay, that means you have sold off the call options, then the delta hedge can be constructed by buying shares. You see, you have to sell somewhere and you have to buy somewhere. If you are buying shares, you have to sell call options. If you are buying call options, you have to sell shares. That's how it works. Okay, so if you have written call options, means you'll be buying shares. If you have not written call options, okay, you are holding the shares, that you have to calculate how many option cost to sell. So you are buying or you are selling in one. Okay, it's always the opposite. You cannot buy shares and you cannot buy option calls. Neither you can sell the shares and sell option calls. No, that's how you are going to have gain and a loss. Okay, if it is the other way, the alternative method, then it is the number of shares to hold equal to number of option calls sold into ND1. Just check. In the earlier one, it is number of shares held divided by ND1. For the number of option calls to sell, if you want to find the number of shares to hold, how many shares you have to hold to hedge your position, then number of call options sold into ND1. Basically, in this one, two things will be given to you. The third one you have to find out. That is known as filling the blank of finding out the missing figure. Okay, two things will be given to you. Find out the missing figure by using the formula. That's it, you have to do. Now we are going to go through an example. Okay, assuming a call option has a delta of 0.5. Okay, let's use it to construct a hedge portfolio. How are you going to see? A portfolio has shares, a portfolio will have an options also in that, correct? But how to hedge? You need a hedged portfolio. Okay, so assuming a call option has a, and this delta and delta hedges, they will give you for call option only, they will not give you for put option. Remember, they will not make things very confusing. They will give you for a call option. Most of the time they will give you for a call option only. So a call option has a delta of 0.5 for an investor who holds 100 shares. Okay, now you need to find out how many call options she will have to sell or write. Sell and write is the same thing. Okay, you can either say write means selling. How many option calls he has to sell? Call options. To hedge. Hedge means they have to get a ratio of 0.5 only. That is the meaning of finding the hedge ratio. I mean, the ratio should be in such a way that number of share he's holding is 100. How many option calls he has to sell to get that 0.5? You understanding? This is the whole idea of it. You understand this? You understood delta and delta hedging. That's it. That's it. So if you have 100 shares, which formula are you going to use? You want to find out how many number of option cost to sell. It will be 100 divided by 0.5. 100 divided by that delta ND1, which will give you 200 calls. That means, so if you have 100 shares, we would need to sell 200 calls to construct a delta hedge. You see the delta value is already given 0.5. To have the 0.5, you need for 100 share that you're holding, you need to sell 200 calls. There is another way of checking whether you are right or not. Just divide 100 by 200. You have to get 0.5. That means number of shares that you have divided by number of shares that you have to, so number of option calls that you have to sell, which is 100 divided by 200. You have to get 0.5 at the end. That's why. And if you see the number of options that you have to sell is more than the shares that you are holding. 200 calls you have to sell, whereas 100 you are only holding. So number of options will exceed the number of shares unless the delta is 1. It's always like that. The number of options that you have to will always exceed the number of shares. Only if the delta is 1, then it will be equal. Then the number of shares that you have to hold also will be equal. The number of the call options you have to sell also will be equal if delta is 1. If it's not 1, it's the other way around. The call option writers, the seller of the call option, okay, the call option writers means the one who is selling the call option will find out how many shares they will have to buy. That means how many they are buying from you. Okay, let's explain this with an example. If the share price increases by 10%, the call option increases by 5%. See, definitely understand this. Share price increases by 10%. Share price increases means what? The value of an option will go up, right? Value of your option will go because now you are more likely to exercise that call option because share price increases. We went through that summary later. The share price increase, value of call option will increase. If you have forgotten that, by the way, you need to go and revisit back and you need to go through that summary, that value of the call option increases. But how much it increases? Maybe not 10 cent, not exactly equal. Share price increase of 10% will not lead to exact 10 cent increase in a call option. It could be more or less. In this case, it's 5 cent. Okay. However, as we have sold the call option, we have sold that call option. Our portfolio decreases by 5 cent for every call option sold. See, we have a value for an option, but we have sold that call option to someone else. So we could have got the benefit of 5 cents, right? From that value, from the having that option, but now we are selling that option, so we are losing that 5 cents. So it will decrease. So there will be a decrease by 5 cents for every call option sold. Our portfolio decreases by 5 cents. Understood? This is the table if you're not understanding. Delta current position is 0.5. They said share price was 100. Now share price increases by 10 cents means it will be 10. Only the increased amount, okay? Number of call options sold. Earlier, what was your position? 200. Now because share price increases, you're losing 5 cents. Because you're selling the option. So 5 cents into that 200. 10 cents. Just understand. In the share purchased, you are gaining 10 because share price increases by 10. But in the option, since you are selling that call option, you are losing $10. So you are gaining $10 in the share price, losing $10 in the option. 10 minus 10, overall gain or loss, there is no overall. Delta is neutral. That means no gain, no loss. It is 0. That's what delta hedge does. This is what they are trying to do. They are trying to neutralize the delta, making it 0. No gain, no loss. But there's a difficulty in this. Delta value is not at a constant. Delta value keeps changing. As the share price changes, delta also will change. Now, let us go through another example. Suppose 10 cents move in the share price, okay? Share price is increasing by 10 cents, but that is causing the delta also to move to 0.7. Delta is also changing with the share price. Now what happens? Now you need to first find out how many calls to sell, how many option calls to be sold. That will be, there's a formula for that. You multiply delta by the call. Already you have 200 calls before, so 200 into 0.7. 140 shares. You have to sell 140 extra shares now. 40 extra shares because earlier you were selling 100. Shares that you have was 100, now 140. So 40 extra shares. Option writer will need to buy means you are selling them. They are buying from you, you are selling them. 40 extra shares. The portfolio will need rebalancing. See, this portfolio will keep changing. If the delta value changes, like how it changed here from 0.5 to 0.4, delta value also will change, portfolio. But how much that change, delta will change, is measured by another thing, another term that you should know. It is known as gamma. What is this gamma? Gamma, see all these definitions you should know. What is delta, what is gamma? It measures the rate of change in delta itself changes. Earlier the delta was changed in the option value. Now that delta itself changes. How much it changes, the rate of change. That is known as gamma. As the underlying price, asset price changes. Same. As the share price changes, what is the change in the delta? A high gamma. You need to understand what is low gamma, what is high gamma means. A high gamma value indicates that the delta value is quite volatile. If high gamma value means your delta keeps changing very rapidly. That means delta value is very volatile. It's not stable. Low gamma is the opposite of it. It is quite stable. So what happens if there's a high gamma value? It will be very difficult for an option writer to maintain a delta hedge. It's very difficult to maintain that delta hedge. Because if your delta value keeps changing, every time you need to change the number of options written, options sold. Now, the third term that you need to know, theta. What is theta? Theta measures the rate of decline of a value of an option caused by passage of time. How much the value of an option goes down from a passage of time. Option price has two components. We went through that. One is intrinsic value, the other one is time value. But when the option is about to expire, will it have any time value? No, time value is 0. But it still have some value, that is intrinsic value. So therefore theta measures how much value is lost over time. So because time value is to 0, time value, there is no time value, it is 0. Theta measures how much value is lost over the time. There were two more measures, rho and vega, which is removed from your syllabus. So I'm not going to explain that. Okay. Vega is the changes in the standard deviation and rho is the changes in the interest rate. Maybe the examiner feels it's not very appropriate or it's quite not so important. So whatever the reason is, they have excluded it from your syllabus. So I'm also not going to explain that. Only these three you have to know: delta, gamma, theta. Okay, go through this. This three is enough. And a calculation part will only come in the delta if delta hedge is required. Delta hedge things. Like how many option cost to sell or how many shares to buy. Only this. Out of this, they will not ask. Gamma, theta, only discussion. No calculation. Now we are moving towards our main topic, that is real option. What is real option? See, in reality, think when you have to make a decision whether to invest in you have a kind of an option, right? Whether you want to invest or whether you want to, after a certain point of time, you don't want to. Because when we are calculating net present value, it has some limitations. Net present value always assumes that whatever the time period is, let's say a project is for 4 years, we are going to do that project until the end of the 4 year. We are going to go ahead with the project. But in reality, is it so? There could be so many things. We might stop the project in between. We might expand the project after the project is over. We might delay the project. So this flexibility is not taken when we calculated the net present value. But real option says option also has a value. Just now we saw that option has a value to it. So because of that value, it will increase your value, overall value of your investment. Maybe it will help you to make a better decision whether to invest in a certain project or not. See, sometimes some value project, when you go by the net present value only to take a decision whether to invest or not, it might give you a negative net present value. So based on that, you might not accept the project. But option, because of option might have a value which might turn your negative net present value into positive. You need to add both the figure, Net present value versus your value of an option. That's how you decide whether you're going to invest or not. So that's why we're going through real options. Okay, that flexibility that option gives, that flexibility has a value. It adds value to your investment to make you take a decision. Second, financial options are example where this flexibility can be valued. Yes, all these options, they have flexibility and they can be valued. We just saw, we went through Black-Scholes option pricing model to value it. If options didn't have value, why would we spend so much of time studying? Right? It has a value, that's why we have. Third, conventional investment appraisal techniques. What is it? The net present values. They undervalue flexibility. They think world is very, there's no flexibility. You have to go for it. No, there are flexibilities. Within projects with high uncertainty, some projects are very uncertain, you might have some kind of flexibility. That flexibility needs to be given value too. Real options attempts to classify and value flexibility. Okay. See, real option and financial, the options that we just went through, they are not real options. Okay. But using that concept of option, we can build that idea in the real option and give a value to real option also. Because whether real option or financial option works in a similar way, they both have a value. There are 4 types of real option that you need to go through. I have not explained you the detail. There are 2 technical articles on your ACCA website. Please go and read it. One is, I think, I forgot the name. The other one is real options in investment appraisal. Yeah, there are 2 technical articles on real options. Please go and read it. And there are some questions. Do it. It will help you a lot. The 4 types of real options are option to expand, option to delay, option to switch, and option to abandon. In reality, you have an option to expand. Sometimes it happens that you might build, let's say, a 1 story. Let's say you're building a hospital or school or whatever, a shop or restaurant. You build 1 floor. Later, you are thinking that maybe after a year or 2 years, you might need more space because customers' demand will increase, and also so better than doing it later, why not keep a certain option that you will have an option to expand later on if you want. Just build another floor to it. Option is there for 1 year or 2 years. So that is known as option to expand. Option to expand and option to delay, they are call options. The way call option works, they work as a call option. Whereas option to switch and option to abandon are examples of put option. Okay, this you should know. Option to delay, sometimes you have an option to delay also. Maybe you want to wait till market conditions improve or you get more information from the market, so you have that option to delay. You have to give that value. You need to find the value of that option to delay, how much value it is. Third is option to switch. Sometimes you can switch in between. If you feel the demand is not going, the market is not doing well, you switch to some other product, some other service. Option to abandon, you totally abandon. So these are the 4 types of options. Now let's illustrate this. I've already explained you, but now we'll go through another example. When looking to develop their stadiums, many football clubs, they face decision. What is that decision? Whether they have to build 1 or 2 tier stand. See, if 1 tier stand is there, it's good because it's cheaper for them. But it will be a problematic later on if their attendance improved. Club's attendance is very high. Then 1 tier will not be able to support. But if 2 tier is built, what happens? They can accommodate a lot of people, a lot of fans could be accommodated, but this is expensive. What if the demand does not go like that? What if less people come than expected? So in that case, it will be seen as a waste of money. So rather, don't go for 1 straight away, don't go for 2 straight away. Rather, some clubs, what do? They build 1 tier stand, okay, but they build it in with such a stronger foundation, okay, that if later they want to add that second tier, they can easily add to it without knocking down the first tier. They keep some space or some foundations in such a way they build when they are building the first tier that if later the demand increases, they can build up the second tier if the demand increases. Maybe they can position the exit or the corporate boxes, things like that. So that is a real option. You have an option there to expand. Okay, so that is, you need to first identify. Once you, because not everywhere options are there. If once you have identified real option exists, yes, now you need to value. How do you value real option? Financial options, we saw how we valued Black-Scholes option pricing model. Thankfully, same Black-Scholes option pricing model can be used to value your real option also now. And all the 5 variables will come again into the picture that affects the options. Now it will affect the real option also. Only certain things are changed when it comes to real options. This change you should be aware of. In the exercise price, what do you take as exercise price? It was PE. Normally exercise price they will give you. But when it's a real option, you take the capital investment. Capital investment to expand or to delay. That should be your exercise price. That means how much money you need if you want to expand or how much money you want if you want to delay. That is taken as an exercise price in the real option. Why only option to expand and option to delay? As I told you, only these 2 options are call option. Remember, you have to identify correctly. Option to expand and option to delay are call option. Because if you do not take it correctly, when you are valuing the real option, you will go wrong. Black-Scholes option pricing model. The way you value the call option and the way you value the put option are different. Formulas are there. That's why you first need to identify the real options as call and put. First 2 are call, option to expand and option to delay. Option to switch and option to abandon or put option. Where we are going to use the put call parity to calculate. But remember, in an exam, they will not give all the 5 options, four real options. Only out of 4, 1 will come. You need to identify out of those 4, which one is it? Is it an option to delay? Is it an option to expand? Is it an option to abandon? Is it an option to switch? Out of this 4, you need to identify that one first. The moment you identified, second is it's a call or a put. If it's a call, go by the Black-Scholes option pricing model and do it. If it's put, add another thing, put call parity and calculate that. That's it. But there are some changes. The way you calculate exercise price in the financial option versus real option. Exercise price in the real option, you have to take the investment in the option to expand or delay. Second, if it's for an option to abandon, what should you take as an exercise price? Take the salvage value. Salvage value. Okay. Time to expiry, the second variable that affects option. If it affects option, it will affect real option also. We go by that assumption. So all the 5 variables you will see again it is repeated. Time to expiry, this is very simple. They will give you. This no change is there. Volatility is also not much an issue. Same. But in this case, you can take future operating cash flows. Okay. Underlying asset could be that. The volatility, how much, what is the volatility of that underlying asset? That means what is the volatility of the future operating cash flow? This you can take it as a volatility. That means standard deviation. But this is also very easy to give. You don't have to calculate volatility. They will give you it. They will give it to you. Value of the underlying asset. Here the changes are there. Earlier you use share price. Now you cannot use share price. This is a real option. What should you use? You should use the present value of the future cash flow, because this is the option to expand or an option to delay. So from that, if you, let's say option to expand, you're assuming cash flows will come in if you expand. So that's why present value of future cash flow should be used as a value of the underlying asset. If there's any initial investment, you exclude it. Okay, that is not taken into the picture. Only the present value of future cash flows. Then this could be the value of the project being undertaken for a call option. Whatever the present value of the future cash flow, that is taken as the value of the project or the underlying asset, you can say. But if it's a put option, what is it? Value of the cash flow that you have foregone. That means you're going to sacrifice opportunity cost. You're not going to get this cash flow. You're going to lose on it. For example, option to abandon. If you go to this is the amount of cash flow you're going to lose. That is the value of the cash flow that you have to take as a value of the underlying asset. For the put option. Call option, it's easy. What is the amount that you're going to get? Present value of the future cash flow. Risk-free rate. Okay. Risk-free rate you can use for real options. Even though some argue that higher rate should be used for real options because they are more risky. Earlier you are taking for financial options is easier. Risk is less because you are going with the share price. Here you are taking the present value of future cash flow. That is more risky. So they assume the risk-free rate should be higher. But nevertheless, you normally use risk-free rate only, okay? That is just an argument. You can use the risk-free rate, how you have used normally for the financial. So the only changes are in the exercise price and the value of the underlying asset. Only these two areas changes are there when it comes to real options. Other the risk-free rate, standard deviation, and the time are same. So now let us go through 3 questions to understand real options better before we move on to the other uses of Black-Scholes option pricing model. Valuing real option. A UK retailer is considering opening a new store in Germany with the following details. Note that all figures have been converted into the domestic currency. So we have estimated cost 12 million, present value 10, net present value is negative. Now, if you go by the traditional net present value, you would say the project is not valuable, it is negative net present value, so reject, right? However, if the first store is opened, the firm would gain the option to open a second store, an option to expand. Okay, so now they have already given and they will give you those things. Okay, for example, timing 5 years, estimated cost. Okay, the cost to expand is 20 million. Present value of net receipt, you will see things like this. Sometimes they might not even write this, whether it's P or PA. You need to understand from the passage. Estimated cost means exercise price. Present value of net receipt means price of the underlying asset, which is 15 million. Volatility of the cash flow, that is standard deviation 28.3%, risk-free rate is 6%. Okay, this one, and this one, there will be not an issue. The only issue is in identifying the correct exercise price and the correct underlying price of the underlying asset. Okay, if it's an underlying asset, you will find things like this: present value of net receipt. If it's an exercise price, they will write about cost, estimated cost and all. So this is an option to expand. Identify, when it's an option to expand, you have to identify the call option. Why? Because you will know in the Black-Scholes option pricing model how to value. That's why. Now calculate the value of the call option. Here they are saying also value of the call option. In your exam, they will not tell you. You need to identify whether it's call option or put option or what. Because if your identification goes wrong, for example, call option, instead of call you wrote put, then the way you will calculate the put, it will go wrong. Even though marks will not be cut because automatically you'll be doing the call, but final answer will be wrong and you will be working more additional time you will be taking to calculate that put, and then you will explain put and all those things. So now what? D1, D2 will calculate. I'm not going to use the formula. Straight away I'm going to put the number. So logarithm of PA over PE. PA is present value of net receipt 15 over exercise price, which is 20, plus R. R is 6%. You cannot use 6%, you have to use decimal, 0.06, plus 0.5 is fixed in the formula, multiply by S squared. S is 28.3%. That means 0.283 squared. The whole thing multiply by time, that is 5. Take the whole. Again, standard deviation 0.283 multiply by square root of time, that is 5. Okay, do your calculation. D1 should give you whatever it is 2 decimal places, because normal distribution table you have to use 2 decimal places. 0.33. Okay, now we'll calculate D2. Make sure you get this. D2 is D1, which is 0.33 minus S square root of t. Simply this you can take here, bring it down, 0.283 into square root of 5. Okay, this will give you minus 0.30. This is something different. This is the first time you are dealing with a minus figure. Calculation is little different. Okay, so this Now, next step, step 2. ND1, ND2. First one, not an issue. It's a positive figure, greater than 0, add 0.5. So 0.5 plus, go to the table, 0.33. Okay. I don't have the normal distribution table attached with me right now. But when you go through this, you will see this. Like this it is. And then 0.00, 0.01, 0.02. Like this it is. And some 4-digit numbers will be given. Okay, XXXXX. So this is 0.33. So you start with 0.3. Second decimal place also you want 0.3. So you have to take this. So whatever the digit here, the 4 decimal place, this is the answer that you have to take. Okay, go to that table, get it, and put that figure. Make sure you get that figure and don't just copy my figure. So the amount will be 0.1293, which will give you 0.6293. D1, not an issue. D2 is an issue now. It's a negative figure. What to do? Again 0.5, but this time minus. Same way you have to use. How you have used for 0.3, 0.30, same amount you have to calculate. Probability will not be 0. So this 0.3 and it will be 0.00. Whatever the figure here, this figure you have to take as it is. Because it's minus, just minus it. So it will be 0.1179, which will give you 0.3821. Okay, now put it in the call option and take it. PA into your ND, that means price of underlying asset, that is 15 multiplied by your ND1, which is 0.6293, minus exercise price is 20 multiplied by ND2, that is 0.3821, multiply by E to the power minus R is 6%, time is 5. Finally, the answer that you have to get, if you feel the calculation is going a bit fast, you can pause the video in between. Do it yourself and go with me. Do this on your own with me while I'm doing it. If you just see it, you will not understand. 3.8 million. 3.8 million is the value of the call option. You have to stop here. This is call option only. That's not enough, guys. Since you have been given the net present value, even in your actual exam, whenever they give you real option, they will give you the net present value. Either you have to calculate net present value on your own and then the value of the call option, which will be too much if you feel so, but it's not. Because I got a question like that and it came as a 50 marks question. If you get this question in your first question as a 50 marks question, definitely you have to do first find the net present value, then find the value of the call option or the real option, and then add both of them together and then decide. If it comes as a 25 marks question, what they would do is net present value they themselves will give you. You just have to find the value of the option and then decide. It could be either anything can come up. Be prepared for anything. So net present value was what? -2 plus this is 3.8, which will give you an overall 1.8 million gain. So you should accept the project or not. Now the project is worthwhile. Accept it. That you should write it in sentence. You should be able to write it in sentence also. The project should be accepted. Now, this was a call option, valued option to expand. Now we are going to go through a second type of example, option to abandon. That is a put option. We'll see how that will look like. Now we are going to go through another question where this time it's an put option, option to abandon. Okay. So in AFM, okay, option to switch, there will be no calculation. Okay, they will only be tested in the discussion. So it could either be option to delay, option to expand, or option to abandon, which will be asked in calculations as well as discussions. But if it is regarding options to switch, it will only be tested as a discussion question. Now, this is the question. They have given you the present value of cash flow for the 5 years, for the 4 years. Okay. Net present value is negative. They have already calculated it. You also can calculate, just add all and minus it by 100. It will be minus 8,000. The project would be rejected. But after 2 years, they have an option to abandon and receive 70,000 for the sale of the asset. So the risk-free rate is 5%, volatility is 20%. Okay, they have given, project is 4 years, everything is given. Now you need to find out what? The value of the option using Black-Scholes option pricing model. What else? But before that, you need to find out, you need to know what is the exercise price and the underlying price. Standard deviation, time and risk is okay, it's fine. So what is your PA? What should be your PE? These are the two things you need to find out. PA is your present value of cash flow. What? This is a put option. Present value of cash flow foregone that you have, because it's an abandon option to abandon, put option. Here it will be present of cash flow foregone if we abandon the project. Okay, so what it will be? You just have to add this 3rd year and the 4th year's present value of cash flow. You are going to give up on this. You are not going to receive it. See, because this is year 2. After this year, if you abandon, you're going to miss out on 30 and 35. So add 30 plus 35, which will be 65,000. It's in thousand. 65,000 cash flow you're going to forgo. So this 65,000 is your underlying asset, PA. What about the exercise price? Exercise price is what you are going to receive from selling it. That is this 70,000. Okay, so now you know all the 5 variables. Always, before you start valuing real option using Black-Scholes, make sure all your 5 variables are there. You should know it. Your risk-free rate, your standard deviation, your time, your exercise price, and your underlying asset price. Then you calculate D1. Okay. This time, I'm not going to calculate D1 for you. You are going to calculate D1. Okay. You already know this and this. Okay. 0.23 will be your D1. Make sure you get the 0.23. Because my focus is not on this, my focus is on the put option part. Okay, by now we have already done 3 questions on this. This is a negative. Okay, n d1, n, I'm just giving you the answer because this is just mechanical work. Once you know it, you can just put the number. Now you need to, so the call option value, okay, once you use the main formula, call option will be equal to, the value of the call option will be in $sign 8006. But it's not enough because this is put option. So you need to find put option. Okay, using the put call parity, the formula, the value for the put option will be, it will be less than the call option, definitely. 6342. Make sure you get this. So in this case, okay, tell me whether the project will be accepted or not. How can you decide? Tell me now. Just add the 2 figure. Just add this with your present value. What is your net present value? Negative 8,000 plus 6342. Even after adding, you are getting negative 1658. Reject the project. Even after adding the value, you are not getting a positive return. So reject the project. Now we are going to do one more question, and that will be our last question on real options. Manny's company is considering investing in the following project. As you can see that they have free cash flow 500 negative, then 120 inflow, and then second year 200, and from year 3 to 8, 160. Discount rate of 10% is used, and using that they have already got the net present value of 19.7%. See, whenever they have already got the net present value using the discount rate, you don't again go and try to discount using by 10% and try to check whether this net present value is correct or not. Don't do that. Sometimes in the exam they give like this, and I know for a fact that most of you try to discount the free cash flow by the 10% and then you try to find the net present value on your own. There is no use of it. It's already correct. They will give you the correct figure, right? Because it will consume a lot of time, because our focus is on the options rather than a net present value. And if you see 19.7, this is a very small positive net present value. Okay, so now the financial manager feels that this project is undervalued. Okay, so now they feel that large cash outflow at the end of year 2 is discretionary and does not have to be made. Okay, if circumstances have changed and the project is not proving to be as successful as had been hoped. Okay, so this cash flow, if you see 500 negative 120, okay, this is split into two. Okay, split the original project into two. An initial investment of 500, and it will produce a net cash inflow of 120 for the following 8 years. That means just first year it will be negative 500. After that, from year 1 to 8, 120, 120, 120, like that, and a further investment of 320 after 2 years. After 2 years means year 0, 1, 2. After 2 years, there will be a further investment of 320, which will increase the net cash inflow by 40 to 160 per year for the remaining 6 years. That means after year 2, they are going to invest 320. Okay, this will increase the net cash inflow from 40 to 160 for the 6 years, remaining 6 years. If you see here. Now, the project is now viewed as an initial expansion costing 500, then phase 1, followed by an option to expand further after 2 years. If separate net present value calculations are carried out, okay, then for phase 1 it is positive, phase 2 is negative. And overall, if you want to find out, this minus this is 19.7. 19.7. But even if it's 19.7, rather than going just by this 19.7, it's better to break down this like this into phases 1 and 2. Why? It gives an interesting insight. Okay, if there is no obligation for the company to carry out phase 2, then overall will be 142.2, which is positive, right? And it exists 19.7. So at least you can be sure that you will be getting this net present value 140.2 from phase 1 if you do not carry out with phase 2. So breakdown of this will help you to show that. Okay, maybe these things you can write as a discussion sometimes. But phase 2, if you see it's negative, it does not look worthwhile currently. But the option to carry out this phase can add value, as an option can never have a negative value. Did we see that? We saw that earlier, right? Intrinsic value will be 0 or positive, never negative. So you cannot say option will not have a value. It will have a value. So if the cash flow expected from phase 2 becomes favorable, the company, they can carry out with phase 2 and get the benefit. So the overall net present value will be 140.2, which is from phase 1. Okay, this 140.2 plus the value of the option to carry out the phase 2. Now you have to use your Black-Scholes option pricing model here to find out that value option of the phase 2. Okay, they have already done it here. Okay, so first you need to find out 5 variables you need: R, S, P, E, P, A, and T. Exercise price you need to find out. Underlying asset you need to find out. Time is given. R, S is given. R is given. S is 50%, okay, and R is 5%. In this example, they didn't give, but here they are giving you the figure. Let's assume S standard deviation is 50%, R is 5%. They will give in the exam, don't worry. And time is 2 years. You already need to work out on PE and PA. What is PE? Exercise price will be the investment required after 2 years to carry out the phase 2. That will be 320. Because after year 2, you are going to carry out this investment. 320. PA, it is the present value of the net cash inflow. PA is always the present value of net cash inflow, which is focused to arise from phase 2. Okay, which will be 144. How? See, this must exclude, you cannot include your exercise price here. Okay, this 144. This 144, how? One 44. How is it 144? Okay, anyway, maybe they have got it. We'll not calculate it that right now, but it is a present value of net currently focused from phase 2, 144. Okay, now using that, D1 you can find out, D2 you can find out, because you have all the 5 variables. And in this case, both are negative, so you have to, it will be 0.5 minus 0.5 minus that variable, whatever you get. It is this and this. Okay, put it in the formula. This is the call option, and this is an option to expand. So it's a call option only, right? So the value is 12. What is from phase 2? Phase 1, it is 140.2. So 140.2 plus this 12 will give you a higher value. So this makes the project more attractive now. Right? If you just go by phase 2, you will see it's giving a negative 120.5 here, whereas here it's giving 152.2. So you will go ahead. It is worthwhile to expand. Because phase 1 itself is attractive, adding the option for phase 2 will also expand, will increase the benefit. Okay, that's what we wanted to show here. So now let us go to the other uses of Black-Scholes option pricing model. That's it for real option. There are other uses of Black-Scholes option pricing model, but as you know, that since majority of real option will be tested if Black-Scholes option model is ever asked, so the other users will be asked as a discussion part, not calculation part. Okay, so I'm not going to show you the calculation part. It's there in the textbook. If you want, you can go through, but mostly since discussion part has been asked, so I'm not going to waste my time to show you the calculation part. Okay, in other area that a Black-Scholes model can be used is in equity valuation. Okay, the model can be used to value the equity of a company. How? What is the basic idea? See, a company has limited liability. That means if debt exceeds the asset value, shareholders can walk off. Okay, and when asset is more than debt, then in normal condition, they will run the business. So as you can see, this nature is very similar to call option. You have a right to exercise the option or you do not exercise the option. Same way for limited liability feature, shareholders can walk away if the debt exceeds the liability because it's limited. Their risk is limited. And if they get the benefit is unlimited. Same like the feature of the call option. So isn't it possible? So if both has the similar feature, limited liability and call option, can't we use the Black-Scholes option pricing model to find the equity of a company? to find the value of the shares? We can, right? That's the logic. Now, same for Black-Scholes option pricing, 5 variables are there. For equity valuation also, those 5 factors will come into the picture. The PA, underlying price. Here in this case, it will be the fair value of the asset. For PE, exercise price will go later. S, standard deviation of the asset's value. They will give you. PE, this is the amount that is owed to bank. The exercise price. It's like how for call option, whether you exercise the option or not, you have to pay a premium. Right? Here also, and exercise price is there, right? Normally they give exercise price. In the terms of company, that is the amount owed to bank. The exercise price. Time until debt is redeemed. That is the time. Risk-free interest rate. Note that the value of the PE will not just be the redemption value of the debt. The exercise price. The amount that you owe to bank also incorporates all the interest payments also, as well as the capital payment. Okay, just knowing it is enough. Calculation and all will not be asked. The value of exercise price, that is PE, should be calculated as the theoretical redemption value of an equivalent zero coupon debt. It's there in your textbook. You can go through the calculation part, but I don't think it will be so important for your exam. Then, how for equity valuation? Same way for debt valuation also you can use. Okay, but debt valuation and all, it normally does not come in the question. Equity valuation, yes, as a discussion, but debt valuation, I didn't see a question. Okay, but still be prepared. The value of a risky bond issued by a company can be calculated as a value of an equivalent risk-free bond minus the value of a put option over the company's assets. Okay. So if the value of the equity has been calculated as a call option, how do you find the value of the debt option? As a put option. Equity for call, debt for put. Okay. So just use your Black-Scholes option pricing model, put call parity and find the value of the debt. Now, that's it for options. Now let us summarize what we have discussed. We have discussed the 5 factors that derives the value of the option. One is your risk-free rate. Higher the risk-free rate, higher the value of the call option, higher the value of the put option. Volatility, your standard deviation, same. Higher volatility, higher the value of the call and the put option. Exercise price, higher the exercise price, lower the value of the call option, but higher the value of the put option. Time to expiry. Under both call and put option, the value will increase if time to expire increases. Underlying price. If underlying price is higher in the call option, value of the call option improves. If underlying price is high, value of the put option decreases. Then we went through Black-Scholes. Limitations we went through, right? That it assumes no taxation, no transaction cost. Then no dividends will be paid. All those 5 to 7, I think 7, 8 limitations we went through. Go through that list. Value in call options. How do you value call options? And using put call parity, how do you value put options also? Delta hedging we went through. Then gamma, theta. Gamma measures the change in the value of the delta. Theta measures the rate of changes, decline in the value of the option over the time. Right? Delta is changes in the value of the option due to changes in the share price. Then we went through real options, the 4 types of real option. Option to expand and option to delay are examples of call option. Option to abandon and option to switch are put option. Option to abandon, option to switch, only discussion part will come. Okay. Then we valued using Black-Scholes option pricing model, where we changed some variables, especially exercise price and the underlying price. When it comes to real options, we did some adjustments. So that's it. And also the other users of Black-Scholes option pricing model to value equity and debt. So that's it for this lecture. Hope you like this lecture, and don't forget to subscribe to my channel if you haven't subscribed. I'll be coming with more lecture, inshallah, and see you in lecture 3 of AFM. Till then, take care.